Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Mastering Fundamental Analysis, a complete guide for investors. Price to earnings, P/E ratio. The price to earnings, P/E ratio is a bit like a company's popularity score. It shows how much investors are willing to pay for each dollar of profit. Why is the P/E ratio important? Comparison tool. It's handy for side-by-side comparisons between companies in the same sector. Imagine comparing athletes in a competition. The P/E ratio helps you weigh who's performing better or worse than their peers. Indicator of market perception. A high P/E might mean investors expect future growth, or it could be a sign that a stock's price is inflated. Conversely, a low P/E may suggest undervaluation or potential problems lurking below the surface. By examining the P/E ratio, investors can gauge whether a stock's price logically aligns with its earnings power. Price to book, P/B ratio. The price to book, P/B ratio serves as a magnifying glass for understanding a company's net asset value. Think of it as peering into a company's balance sheet to see its financial worth compared to market expectations. Key points about the P/B ratio. Market versus book value. The ratio compares a company's current market price with its book value, essentially, the value of its assets minus liabilities. A P/B less than 1 might suggest a stock is undervalued, while a higher P/B could indicate that the market expects future growth or profits not reflected in current asset values. Assessment of financial health. Companies in industries with many tangible assets, like manufacturing, often leverage the P/B ratio as a key metric. It helps investors see if the market value is reasonable compared to what the company actually owns. Understanding the P/B ratio provides insights into whether investors are paying too much or too little compared to the firm's actual worth. In essence, valuation techniques enable investors to dissect financial statements like a seasoned detective, helping them make informed decisions rather than pure guesses. These methods are the compass for navigating the financial seas, providing clarity amidst the waves of market prices and speculation. Limitations of fundamental analysis. Fundamental analysis is like examining the ingredients of a recipe to predict how a dish will taste. While it's a powerful tool, it's not without its faults. Let's explore a couple of these challenges, looking at how personal opinions and outdated data can throw off our predictions. Subjectivity in analysis. When conducting fundamental analysis, personal bias can sneak in like a guest who overstays their welcome. Why does this happen? Our beliefs, experiences, and assumptions often color our interpretation of financial data. Analysts might prefer brands they personally trust, which can lead to biased forecasts. Dismiss valid information because it conflicts with their past experiences. Feel influenced by recent trends, leading to skewed predictions. Think of this like a detective working on a case. If they have a gut feeling about a suspect, they might overlook clues that point in a different direction. Similarly, personal bias in analysis can cloud judgment and lead to inaccurate conclusions. Time lag in data. Imagine trying to catch a train using last year's schedule. This is similar to how fundamental analysis sometimes operates, using financial reports that are not up to date. Why is this a problem? Because markets move fast, and data can't always keep up. Here's how the delay can affect analysis. Quarterly reports. By the time they're publicly available, conditions may have changed. Annual data. These reports take months to compile, missing swift market shifts. Economic indicators. Often lag behind actual economic conditions. This delay is like reading yesterday's weather forecast to plan your day. It's informative but potentially outdated. In a dynamic market, relying on past data can lead to decisions that miss the mark. Fundamental analysis offers valuable insights, but its effectiveness can be hampered by personal biases and outdated information. Being aware of these pitfalls can help analysts make smarter, more grounded decisions. Integrating fundamental and technical analysis. When it comes to making smart investment decisions, using both fundamental and technical analysis can be a powerful strategy. Think of these methods as two sides of the same coin. While fundamental analysis helps you understand a company's true value, technical analysis gives you insight into market trends and patterns. By combining them, investors can gain a more complete picture and make better informed decisions. But how exactly do they work together? Let's explore the benefits and techniques of integrating these two methods. Strengths of fundamental analysis. Fundamental analysis focuses on evaluating a company's financial health. It involves looking at various elements such as earnings, reviewing past earnings, and predicting future profits to assess value. Revenue. Understanding where a company's money is coming from and its business model. Assets. Evaluating what a company owns and how it supports growth. Liabilities. Checking if the company has too much debt, which can be risky. This analysis helps to determine if a stock is overvalued or undervalued and guides long-term investment strategies. Advantages of technical analysis. On the other hand, technical analysis revolves around studying price movements and trading volumes. Charts and patterns. Identifying trends through chart patterns helps in understanding market sentiment. Indicators like RSI and MACD. These tools can signal when a stock is likely to change direction. Support and resistance levels. Recognizing these levels helps predict when a stock price will move. Technical analysis is often used for short-term trading decisions, as it provides insight into daily market activities. The power of combining both methods. Mixing fundamental and technical analysis can give you the best of both worlds. Here's how they complement each other. Confirming value. Use fundamental analysis to find potentially undervalued stocks. Then, check technical signals to confirm trends before investing. Timing the market. While fundamental analysis tells you what to buy, technical analysis helps you figure out when to buy or sell. Risk management. By using both methods, you can better manage risks. Fundamental analysis gives you a strong foundation, while technical analysis offers clear entry and exit points. Integrating the approaches can help investors avoid emotional decisions, which often lead to mistakes. It's like having a map that not only shows where the treasure is but also the safest path to reach it. Using both methodologies can enhance your investment journey and pave the way for strategic decision-making. While each method has its followers, combining them opens the door to a more balanced and insightful investment approach. Conclusion. Wrapping up, the essentials of fundamental analysis empowers you to make informed investment choices. By getting a handle on the core principles, you're more equipped to tackle the ups and downs of the market. But why does it matter so much, and what should you take away from all of this? Key takeaways of fundamental analysis. Understand the company's value. Imagine a company's stock like a basketball team. You wouldn't just look at the final game score, right? You'd want to know how each player performed, who scored the most, or how well the defense played. That's what fundamental analysis does for stocks. It looks beyond the price, evaluating everything about the company. Assess financial health. Studying balance sheets, income statements, and cash flow helps you see if a company is thriving or just scraping by. It's like checking the engine before a road trip. You want to make sure it's all running smoothly. Evaluate economic conditions. External factors like the economy's health or interest rate shifts can impact investments. It's like considering the weather before going on an outdoor adventure, essential for preparation. Long-term strategy. Fundamental analysis is your navigation tool for the long haul. It helps you decide if a stock is worth holding or if it's best to jump ship. Importance in investment decisions. Informed choice. Just as a wise shopper checks reviews before buying a product, you should evaluate stocks with thorough analysis. It reduces the risk of making investment blunders. Spot opportunities. With fundamental analysis, you're not just riding the stock waves. Instead, you're like a treasure hunter, spotting undervalued stocks before others catch on. Greater confidence. Understanding what drives a stock's value gives you a real confidence boost. You're not just guessing, you're making decisions backed by solid data. When you approach investing with fundamental analysis, you don't just throw money at stocks and hope for the best. You're crafting a strategy, carefully choosing where to put your resources. So, next time you consider investing, think about these takeaways and how they can help you in making smarter choices. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.